there are kind of two or three elements in there. First of all, once you're closing around the $50 area, shale starts becoming very questionable in some of the projects in Permian in particular. And they've already been having problems in terms of distribution bottlenecks. So, let's put that element, the price of oil will determine what's going to happen in terms of E&P activity. Number two is the idea of the Iran deal and the exemptions, 800,000 barrels, was not expected by the market, so there's more supply in the market than what had been anticipated. And lastly, there has been some sluggish demand, but primarily coming out of non-U.S. marketplaces, particularly China, where there's been some weakness, and that's been kind of the incremental driver for more demand. So energy's been under pressure from a number of different perspectives. The lower price is a clearing mechanism. Is it good for consumers? Yes. Is it bad for Texas economy? Yes. So it's kind of a little bit of a push either way.
The weird thing about that is, as you're pointing out, demand, the picture has been weak in areas, but not in the United States. Morgan Stanley, we had an analyst on earlier this morning on Worldwide Exchange, and he made a pretty big call. He is taking down his weighting on U.S. equities, taking it to underweight. At the same time, he is double upgrading his view on other stock markets, equities around the globe, where he's now saying he's overweight on those situations from an underweight situation. Is that something that you agree with?
So our global view is that emerging markets have some opportunity as well. U.S. has been a bit of a safe haven market relative to the world. The economy is stronger here. We got the buyback activity here. We've got a stronger economy here. All those are very important dynamics. What I would suggest to any investor who's trying to think about global positioning is look at the dollar. If you have a very strong view on the dollar going higher, U.S. tends to outperform emerging markets, tends to outperform everywhere in the world as money kind of gets drawn here. Now, I'll come back to that in a second. If the dollar weakens, then the other markets are better places. What's strange is that the absolute level of the market is not tied to the dollar. There are periods where the dollar is strong and the equity market goes up, and there are periods where the dollar is weak and the U.S. equity market goes up. It's more of a relative play against these markets around the world. So our view as a firm is that the dollar will move up very modestly from here. So that's not as powerful an argument.
Meaning the Fed is likely to moderate its rate hikes because the dollar is going to be trading mostly on that,
You have to be careful with that.
If we continue to raise rates and other markets can't keep up with that, other banks can't keep up with that.
So the other central banks are kind of moving. Even the EU, which is viewed as the most dovish, or the ECB specifically, is the most dovish. Even they've indicated that they're going to reduce their purchasing activity. Kuroda's made some comments in Japan as well. So it's a relative move argument, not just we raise rates alone. And that's been the most important dynamic. If you look over time, just look at the difference between the 10-year Treasury yield and the Bund yield in Germany and look at a dollar-euro, you pretty much have that relationship very consistent over 20, 30 years. So we can't just look at the Fed moving in a vacuum. We've got to look at other places. Again, I'm not going to make the strong dollar call. It's not my it's not my view. That was, I think, Bob Rubin or Bill Clinton's calls. Right. But the idea of, if you believe the dollar is going to get meaningfully stronger because you're worried about crisis, trade wars, those kind of things, or the U.S. economy doing that much better, then the U.S. market will tend to outperform. Again, that's not really our view. Our view is slightly stronger dollar.
All of that is kind of subtleties in terms of which direction things are headed. What would you tell people to do right now? Because a lot of people are coming back in, having seen not only the devastation in their portfolios from the month of October, but watching this kind of pile on through the month of November, too, with what we saw Friday with more pressure coming on. What do you tell people to do?
So three things. One, we would tell them that we're much more interested in the market today than we were in September. In September, our panic euphoria model, which is our primary sentiment metric, was telling us 70% probability of a down market. Now it's giving us a signal of a 90% probability of an up market. So we've seen, with this correction, we've seen a very significant change in sentiment and implications to the markets. Number two, there's been a lot of pain, obviously, in the FANG world or in the tech world in general. We've been arguing for value over growth positioning for a long time. We're finally starting to see that happen. People were way too much chasing the momentum of those stocks as opposed to necessarily fundamentals. I mean, the fundamentals are fine, but the momentum of the stocks are carrying them beyond where they should have gone. And number three, you're in an environment where there is some inflation, there is going to be higher rates. Yes, have a higher quality balance sheet portfolio. It's probably a better place to be today. It doesn't mean buy everything, and the term quality is one that's very iffy. I'm going to say higher quality balance sheet. That's where you probably want to have
90%?
90%
probability.
up market from here.
Is that a Hillary Clinton wins the election 90%, or is that a 90? I mean, what kind of 90% is that 90%? And can I bank on that 90%, Levkovich? 90% that stocks go
Joe.
up? Huh?
90% probability.
Well, 90%, doesn't that make you feel better?
Makes me feel, but this is also speaks to this idea that investors are looking for a reason to buy this market. If the sentiment
that would give me a
changes to
reason.
the point-
90%.
Well, no,
But it's on sale.
It's a
The market's
sentiment
on
As
sale.
long as
Right.
it's not that other 90%.
Just keep this statistic in mind, and I always tell people you got to understand the numbers. 78% of the time, the market goes up.
Yeah, it does.
Okay, because we grow earnings, we grow the economy. So what we're looking at is what are the, when we got that signal in September and we were out telling people, hey guys, we're worried, there was a lot of
But do you
pushback.
think that sometimes they call it the Thanksgiving table effect? Do you think that people sat around the Thanksgiving table this year and said, like, we should all get out of the market now because it's a disaster?
Or stocks are really cheap.
Or do you think people sat around saying stocks are really cheap? I happen to think that retailers are much more anxious and sitting around the table going, oh my, have you seen what's going on? What do we do? You know what I mean?
Considering that 50% of Americans don't own any stock, you already have half the people who weren't talking about that. They're probably talking about football.
Okay,
So
take them off the
So of the
list.
other 50%, I would probably say half of them never talk about stocks either. I just think that this is, we live in a little bit of a bubble in our world, and we talk to each other, and yeah, we talk stocks all day long, but the average person doesn't. I was sitting at my sister's dinner table at Thanksgiving. Stocks never came up.
We didn't.